Welcome to today's video. In this discussion, we're going to explore one of the deadliest mistakes that any speculator can make, a mistake that has ruined the careers of many despite their knowledge, skills, and strategies. It's a mistake born out of a toxic combination of ego and hope. And if you fall into this trap, you're almost certainly bound for frustration, loss, and failure. So what is this mistake? It's the amateur's habit of averaging down. This is the practice of adding to a losing position when a stock or asset you've invested in starts declining. Instead of accepting the loss, some speculators view this decline as an opportunity to buy more, thinking they're getting a bargain and lowering their average cost. At first glance, this might seem like a good strategy, but it's not. In fact, this is exactly the opposite of what the professionals do. It stands in direct opposition to every sound principle of speculation. When you average down, you're not speculating, you're fighting the market, hoping the market will change its mind and reward you for your stubbornness. It's a practice rooted in ego and wishful thinking, and it will destroy your capital in the long run. When you buy a stock, it declines, and then you decide to buy more of it at a lower price. You're not following the market signals. The market is telling you your original decision was wrong. The tape, which is the market's way of communicating, is giving you its clear and impersonal verdict. This is not working, but the ego can't accept that. It pushes you to add more, thinking that you're getting a great deal at a lower price. It feels like a second chance. But in reality, you're doubling down on your mistakes, throwing more capital into a losing position. This is how the amateur gets trapped. You're reinforcing failure. Instead of cutting your losses and moving on, you're subsidizing a mistake with more capital. By doing this, you're denying the reality that the market has already made its decision. The true speculator doesn't act on ego. The professional speculator listens to the market, reads the tape, and takes the losses when necessary. They understand that preserving capital is the top priority. When you average down, you're not learning from the market, you're arguing with it. And that's one of the fastest paths to losing everything. Now let's contrast this with how a professional speculator operates. The master speculator has learned how to build positions, not chase losses. They operate on a completely different principle, the pyramiding strategy. This is the core of their philosophy and one of the key reasons for their success. When they enter a market, they don't just go all in. They don't start by averaging down and trying to lower their cost basis. Instead, they start with a small position, a cautious, calculated initial move. This is not a commitment. It's a test. By making a small initial purchase, they're asking the market a question: is this the right time for this trade? They're testing the waters, not diving in head first. Now, let's break this down. The pyramid strategy works in harmony with the market. It's a method that lets you grow your position step by step as the market proves your judgment was correct. Let's dive deeper into how this works. The first move in the pyramiding strategy is crucial. It's called the probe. You've identified a stock that you believe has the potential for a significant move, but you don't rush in with your full position. Instead, you make a small initial purchase, a fraction of your intended full position. This could be a fifth, a quarter, or even a smaller amount, depending on your strategy. This small purchase is not a commitment. It's a test. You're testing your judgment. You're asking the market to confirm whether your analysis was right. If the stock moves in your favor and you start seeing some profits, you'll continue. But if it doesn't, if it falters or goes against you, you take the small loss and move on. There's no ego involved. You don't hope it will turn around. You listen to the market. The market's verdict is immediate. If the stock doesn't perform as you expect right away, it's clear your judgment was wrong. A disciplined speculator takes their small loss and moves on. They do not wait for a miracle. They do not hope. They act quickly, decisively, and without ego. However, if the stock moves in your favor, you now have an important signal. This is the market's way of confirming that your judgment was correct. It's not just about making money, it's about validating your thesis. The stock is showing a profit, and it's doing so quickly. This immediate profit is more than just money. It's a confirmation that your initial judgment was sound. The market is telling you that the trend is in your favor, and that's the validation you need before you risk any additional capital. The key is immediacy. If your trade doesn't show a profit from the very beginning, that's a huge red flag. It's a sign that the market doesn't agree with your thesis. The best trades are the ones that show profits almost instantly. If you're not getting this validation, the trade is likely to turn into a big loss. And a big loss is something that the master speculators simply cannot afford. Therefore, if the initial trade doesn't work out, it's essential to take the loss and move on. Once the first move shows a profit, the speculator now has a new form of capital to work with, the paper profit from the initial trade. This becomes the new risk capital for the next stage. The original risk capital is now protected, and the speculator is effectively playing with the market's money. This provides a profound psychological advantage. The speculator is no longer worried about losing their own capital because they've already protected it. They can now operate with greater confidence and clarity. Their judgment is unclouded by fear. Now that the initial position is secure, it's time to build the pyramid. The second purchase should come at a higher price than the first. Yes, this is contrary to what most amateurs believe. They always want to buy at a lower price, thinking they're getting a better deal. But the professional knows that a rising price is a sign of strength, not weakness. The professional speculator is buying momentum, not value. A rising price is proof that the stock is showing strength. The market is telling them that their judgment was correct, and it's time to build on that strength. This is the first key step in building the pyramid. Once the stock moves in the right direction, the speculator adds to their position, but they only do this after the stock has continued its upward movement, proving that the initial breakout was genuine. This method is buying on a scale up, which is the exact opposite of averaging down. Instead of throwing good money after bad, you're reinforcing success. As the stock continues to perform well, you add to your position, increasing your exposure to the asset as it proves itself to be strong. This is a key difference between the amateur and the professional. The amateur tries to catch a falling knife, buying more as the price goes down, hoping for a bounce. The professional buys more as the price goes up, reinforcing the trend and positioning themselves for greater profits. In the next part, we will dive deeper into the details of how the speculator builds their pyramid, how to manage your position size, and the critical principles to follow to ensure the strategy's success. We discussed how the first step in the pyramid strategy is to make a small initial purchase as a test. If the market confirms your judgment and shows an immediate profit, you can then use that profit as the capital for the next stage of the campaign. With this validation from the market, you're ready to build your position gradually, adding on the way up as the stock proves itself. Now let's continue our exploration of the pyramiding strategy and dive into the next key steps in building a successful trade. As we continue to build the pyramid, one of the most critical aspects of the strategy is psychology. The professional speculator is not just making a financial decision, they're making a psychological one as well. The ability to stay disciplined and remove emotions from the equation is essential. It's easy for an amateur speculator to get caught up in emotions like fear and greed. When a stock is moving in their favor, there's the temptation to rush in and add to the position too aggressively, thinking the trend will continue indefinitely. On the flip side, when a stock is moving against them, fear and doubt may lead them to hesitate and second-guess their judgment. The master speculator, however, has learned to control these emotions. They know that they don't need to rush. They're building their position slowly and methodically, step by step, only adding to it as the market confirms their judgment. In this phase, the speculator is focused on reinforcing success. They're not gambling, they're investing. Their decision to add to the position is based on proven strength. The stock has already shown that it can move in the right direction, And now the speculator is simply amplifying that success by increasing their position. They've seen the initial gains, and they've seen that the market is rewarding them for their judgment. This is the psychology of confidence. It's the confidence to act when the market confirms your ideas and not act out of fear or impatience. Confidence built on real, proven data, not wishful thinking. In the pyramid strategy, the core principle is scaling up. Unlike the amateur who tries to buy more as the price falls, the professional speculator adds to their position as the price rises. Scaling up may sound counterintuitive at first. After all, why would you buy more of a stock that's already risen in price? Shouldn't you wait for a pullback to get in at a lower price? The answer lies in the concept of momentum. The rising price is a sign that the stock is gaining strength. It's not a sign of danger. The market is proving that the trend is real and powerful, and as a speculator, you want to join that trend. The more the stock proves itself, the more you'll increase your position. This is also why the initial purchases in the pyramid are smaller. You don't want to risk a large amount of capital on a move that hasn't yet been validated. By scaling up, you're growing your position as the stock moves in your favor, adding more capital only when the trend has confirmed its strength. The idea is to manage risk while maximizing the potential reward. As you build your pyramid, each subsequent purchase is made at a higher price, reinforcing your belief in the stock's upward movement. But you never increase your position recklessly. Each additional purchase is done with the market's approval based on the stock's proven strength. As the pyramid grows, the speculator must carefully manage their position size to avoid being caught in a precarious situation. It's crucial that the average cost of the total position remains at a level that provides a buffer against any potential market pullbacks. Let's break this down. In Livermore's approach, he would often divide his total position into several parts. For instance, if his total position was meant to be 1,000 shares, he might start with 200 shares in his initial purchase. Then, after the stock moves in his favor, he would add another 200 shares. As the stock continued to prove its strength, he might add another 200 shares, and for the final part of his position, he might add 400 shares. This strategy isn't about simply doubling down or increasing your position by the same amount at every step. The idea is to increase your exposure gradually as the market proves you're on the right track. By spreading the purchases out, the speculator ensures that their position is not too top-heavy. You don't want to risk most of your capital on the last portion of the trade, especially if the stock is approaching its peak. If you buy too much of your position at the highest prices, you leave yourself vulnerable to even a minor market correction. The goal is to keep the average cost of your total position at a safe and profitable level. Ideally, the average price of your position should be low enough to withstand normal market fluctuations. Even if the stock sees a minor pullback, your overall position should remain profitable. One of the most overlooked aspects of the pyramiding strategy is risk management. While the strategy is designed to capitalize on a trend, it also requires the speculator to manage their exposure carefully. The risk is highest at the start with the small probe. This is the speculative part of the trade where the speculator is testing their thesis, but once the position shows a profit and the market has validated their judgment, the risk becomes much lower. Why? Because now the speculator is using house money. The initial capital is protected, and any additional capital used to increase the position is being backed by the profits from the trade. This makes it easier to manage risk without worrying about large losses. However, it's still essential to keep an eye on the overall position size. No matter how confident you are in the trend, it's important to ensure that you're not putting too much capital into any one position. Diversification and managing the size of your positions across your portfolio are key principles to remember. The key here is balance. You want to grow your position while ensuring it doesn't get too large relative to your overall portfolio. You don't want to risk a disproportionate amount of capital on one trade. The final thing to keep in mind is the danger of overextending yourself. While the pyramid strategy can be incredibly rewarding, it's also easy to get caught up in the euphoria of a winning trade. As the stock moves in your favor and your profits grow, you may feel tempted to add more and more to your position. But this is where discipline comes into play. Adding too much to a position too quickly can cause your position to become top-heavy. The risk of a major correction increases if you're too heavily invested in the stock at its highest point. To avoid this, the speculator should always keep a clear plan and never deviate from their pyramiding method. The idea is to build gradually based on the market's performance, not based on emotions or impulses. In the next part, we will go into more detail on how to recognize the right market conditions for applying the pyramiding strategy, how to manage risk even further, and how to maximize your profits as the trend matures. The pyramiding strategy isn't something you can apply to every market. It's designed for clear, strong trends, whether that's a bull market or a bear market. It's not suited for range-bound or sideways markets where prices fluctuate up and down without any definitive direction. If you attempt to pyramid in a market that is not trending, you'll be subject to whipsaw action, where the stock moves up briefly before quickly falling back down. This can result in a series of small losses that accumulate over time, even if the market ultimately moves in your favor. It's a sure way to be whipped to death, as they say. So before applying the pyramiding strategy, it's essential to identify whether the market is showing a clear trend, either up or down. This can be done through technical indicators, price action, or trend analysis. The key is to confirm that the line of least resistance is clear and strong. The professional speculator doesn't try to force trades in dull, choppy, or unpredictable markets. They wait for a definitive trend to materialize, and only then do they begin to apply their pyramiding strategy. Once you've identified the right trend and have begun to pyramid, the next goal is to maximize your profits. While many amateur speculators are content with small, quick profits, the professional aims to ride the trend for as long as possible. The pyramiding strategy gives you the opportunity to do just that. As the stock continues to rise or fall in a bear market, you can continue to add to your position using market-confirmed profits as the capital to do so. This allows you to increase your exposure to the trend without increasing your risk. However, there's a fine line between maximizing profits and overextending your position. As the position grows, so does the psychological pressure. The speculator must always remain disciplined and stick to the plan. The market will signal when it's time to stop. In the case of a bullish trend, this might be when the stock starts to show signs of weakening, such as declining volume, loss of momentum, or when it reaches key resistance levels. For a bearish trend, signs of reversal, like a sudden rally or failure to make new lows, might signal the need to exit. So the question becomes, how do you know when it's time to take profits and exit the trade? The answer lies in the same principles you've been following all along: tape reading and market analysis. Taking profits and exiting the position is just as important as entering it. The speculator's goal is to maximize their profit, not to hold on until the last moment and risk a reversal that turns profits into losses. This is why the professional speculator monitors the trade closely, watching for any signs that the trend is losing steam. As long as the trend is intact, the speculator continues to pyramid and build their position. But once the trend starts to show signs of reversal, it's time to start scaling down. The exit strategy for the pyramiding approach is just as critical as the entry strategy. You should not wait until the market reverses completely and erodes all of your gains. Instead, you should have a planned exit point, whether that's based on technical indicators, price targets, or key support and resistance levels. Once the market gives the signal, the speculator must have the discipline to exit gracefully, taking profits as the market allows. This is one of the areas where many amateurs falter. They hold on too long, driven by hope or greed, and ultimately give up their profits. The professional speculator doesn't make this mistake. They take profits early enough to lock in gains while leaving room for the trade to continue in their favor. As the trade progresses, the speculator's job is to adapt to the ever-changing conditions of the market. This means that while you're building your position, you must constantly reevaluate your strategy based on the new information the market provides. If the stock continues to behave well and the trend strengthens, then the speculator can continue to build their pyramid. But if the trend begins to weaken or show signs of a potential reversal, it's time to adjust and exit strategically. The key here is flexibility. While the pyramiding strategy is a scientific method, it is not rigid. The speculator must be able to adapt to changing conditions, moving in and out of positions as the market dictates. A great speculator can adjust their strategy and plan to meet the market, not the other way around. No strategy is foolproof. Even the best speculators make mistakes. But the key to success lies in learning from these mistakes and refining the process over time. In fact, the greatest speculators in history were also the greatest students of the market. They spent years studying their mistakes and learning how to improve their methods. The pyramiding strategy, like any other trading method, requires constant refinement. For example, maybe you found that you added to your position too aggressively in a previous trade and the stock reversed, wiping out your gains. Or maybe you waited too long to take profits, missing the opportunity to exit at a higher price. These mistakes are valuable lessons. What matters is that you learn from them. Each mistake helps refine your strategy, making you a more skilled and disciplined trader. At the end of the day, the goal of the pyramiding strategy is not to hit a home run with every trade. It's about consistent profits over time. By following the principles of pyramiding, testing your thesis, scaling up, and managing your risk, you can build long-term wealth. The great speculators didn't get rich overnight. They did it through patience, discipline, and the ability to reinforce success while minimizing failure. The pyramiding strategy, when executed correctly, allows you to transform a single correct judgment into a great fortune. But remember, the key is to be disciplined. Stick to your plan, keep your ego in check, don't average down, reinforce success, don't subsidize failure, and always manage your risk. The pyramiding strategy is one of the most powerful tools in a speculator's arsenal. It allows you to maximize your profits by building your position gradually as the market confirms your judgment. It's a strategy based on patience, discipline, and confidence, not hope, ego, or emotion. If you can master the pyramiding strategy, you'll be able to take full advantage of a market that rewards your correct judgment. You'll be able to build a solid foundation of wealth one step at a time and avoid the pitfalls that trap most amateur traders. Now, it's up to you. Begin by applying the principles of pyramiding to your own trades. Start small, test your ideas, and only scale up as the market shows you it's the right time. Keep refining your approach, learning from each trade, and stay disciplined. In the end, the key to successful speculation is not about winning every trade. It's about learning to reinforce your successes and minimize your mistakes. Thanks for watching, and best of luck with your trading.